Okay, this is a second follow-up video about computing LCOE and levelized cost of electricity and evaluating this Lazard study. Now, that's officially what it is. It's really about financial modeling and doing some formatting and doing some analysis in financial modeling. And I think, I've made some videos about these exams and other things. I'm going to make another video a little bit later, and I don't know when, and show you what not to do. Show you really some of the mistakes that you make. Focus on setting up a model, formatting a model, making scenarios with a model, verifying a model, creating financial statements in a model, all of these kind of things. And that's what I'm really going to do right now. Before we get started on kind of this, let's just, this is the second part. So if you've watched the first part, oh, that's fantastic. If you made it through a little bit of the first part, that's even better. At the end of the first part, if you could have made it through there, I doubt it. What we did is we computed some scenarios. Now, I've changed this file a little bit, and like I said, this file is going to be I'm going to put it in a couple of places, okay? Because for me, this file is a little bit more important than some of the others. I think I'm going to put it in this section, and then I'm going to put it in the levelized cost section a few different places. So that's where you could find the file. Here's the website name. And let's go back, okay. And I changed a couple of the formats for the financing, and I said, okay, well, this Lazard case had this thing called, I'm going to pretend that this Lazard case, instead of having a level financing, had a flat financing, and then we changed the tax rates and changed the cost of debt, cost of equity, the capital structure, and then we put things, most importantly, in real terms. And if we, let's start with our solar case. Now, if we, and I think on this one we'll also discuss just a little bit, no, well enough, the degradation. Because degradation, if you really think about projects in your life and your car and just so many things, they don't work quite as well when they get older. There's real obsolescence. There's some diminution in the value, which is like the opposite of inflation, and that really should be reflected. And we're not sure if it's not explicitly in the Lazard analysis, but of course it should be in any solar. So let's run these scenarios. Now, we're going to walk through each of these, but and I've seen a solar project where we went to 40 years, and it's kind of hard that I never seem to change this silly little input. I should have done this perhaps a little bit differently. And there's our solar case. So we start with our solar case, and it's pretty dramatic, the effect of these assumptions. That's, of course, what we went through last time. And this effect of the tax rate really is nothing, because there's this big 5-year tax depreciation, which creates a loss. And we don't put a net operating loss in the model. We just leave it alone. So that's got a kind of somewhere around a 50% reduction. If we now I changed the gas price and put almost an $8 US dollar per MMBTU gas price. And if we look at and notice this time I kept the scale the same. So if let's run our gas, and I think I said, okay, let's take this one here and run all the scenarios. And I think this had a pretty high capacity factor. And when we run it all, we have one kind of reduction to get it in real terms, but this reduction is so much smaller than the solar, especially in percentage terms. And if the gas price is high like that, if we just really would be careful, the right idea would be to compare just the variable cost. When you put in a solar, you can run less gas, so you don't have to worry about, well, it's dispatchable or not dispatchable. That's kind of how we could look at things, and by the time we're finished, that's the capital cost is very minor in this one compared to the operating cost anyway. All right, and then now if we then run our nuclear, and we said that's the best case, and we just quickly change this to I put 65 years, some people use really 60 years probably, but we put these in, and then, this is really kind of dramatic in that the nuclear is now competitive with an $8 US gas price. Okay, and that, remember, the gas does not include all those leaks of methane if you're getting the gas from places in Texas, which could be 1%, it could be a little bit less, or it could be more. This seems to be one of the big unknowns in a lot of the climate analysis. And it doesn't include, so once you kind of, since leakage of gas is 20 times worth as much as CO2, if there was, for example, four times, let's say four times 2, it's an 80% increase in the CO2 from something like that. It's gigantic. We could have a very high cost of the CO2 from natural gas. Okay, that's not in here. So now let's work through some of the fundamentals. Now I go a little bit crazy about this. Again, I've kind of already discussed this, but we put all of our operations into one input file, and we put and I think we're careful to put in the capacity and the cost, and we're careful to put the units in. This LCOE could probably be moved around, and we've got this. Now, and of course, now why is this one, that's got an equal sign, so that's why that's not colored. To just format this, well, let's open the generic macros. Now I have something a little bit new on this generic macros. It's really exciting, and I'm absolutely convinced that, number one, you should not spend a whole lot of time wasting time on this. Let's just put years here, like this, MW. That's too long. Let's put USD D per MW. Okay, and let's pretend now that we're going to reset everything. Okay, and then it asks you if you have, I almost should rename that to conditional formatting. That's what we're really doing. And I'm going to put yes. Okay, if you later want to run this and leave the old conditional formatting things in, you can click off of this. So let's exit and look. So this is what it looks like, and you can see, I think you can see it's very different. Now, I've noticed that people do this kind of thing, and it took me so long. So let's see. These brackets are in 1, 2, 3, 4, the fourth column, okay? And let's, so you did ask what column you want to put. I hope it's in column D. And then it goes through and puts all the units in there, and it's, I think I was pretty careful to not mess up numbers that you could have accidentally in that thing. So let's not waste time on that. Let's also, now we understand that we pull the index function. You could have, I suppose, used a lookup function where you'd say lookup, and you'd say this one against this one. I'm sorry, this one against all of these, and you look up that just as easy. But what the index command is something a lot of us are used to, and as long as it's adjacent, we don't need to use the choose function. And so when we change a scenario number, let's just change it manually. Let's just change it to 1. It's just going to pull this one out. So that's the 55% to, and all we do, it's so easy. It's not worth really even discussing, but you can see why people would like to set your model up like this. And once you have that, let's first just format it, and I put the titles in column B, and I'm going to include conditional formatting. We don't really have many links from the other sheets, and we have, it looks like 7 rows at the top, so you just adjust these, and you know you can go into that. Okay, and it's just, I just thought it's worthwhile showing you this, and finally let's remind what you could do here. If you take all of this stuff here and want to just highlight the scenario you happen to be on, you have to put these numbers up at the top, these numbers here, and then you just go to home. And I've done this wrong so many times, that's why I'm showing it. You go down to new rule, down to use a formula, and you can compare. The easiest thing, you take that scenario code number that drives everything, and you leave that locked, and you put an equal sign, and I have to talk to myself. The row has to be the same. We're fixing the row, but we're not fixing the column. So you do this, and you do the most important part, which is selecting a nice color, and you try to, I'd say a light kind of color. How about this one? And then let's just put that okay. And that's how we do it. Now, then if you reformatted this, let's just say, for example, let's go to this one. We want to, for some reason, use this brown color. Okay, and you can, of course, make your own. You would copy this brown color to it. You would initialize initialize this. You press Control-Alt-C, and then when you make absolutely sure that you're not going to clean the conditional formatting here, okay? Well, I'm not going to really like the brown one much, but okay, it's not that bad. All right, so let's leave that, and we have it. Now down here, I left this kind of in the input page, but you notice they're all black. They're all computed, with one exception. Oh, that's where we'll get to this one later, where we copied the numbers out. But this is showing you how you do not need, for just about everything we're doing, we don't even need a financial model, and we can just run through some calculations as long as we have well, this we've got to run the GOSIC here. I think. Just a minute. Oh, great. Okay, let's start with this one. I don't even need to run that. Right. Okay, and we'll show you that this calculation using degradation, using some inflation on the O&M, we compute an LCOE. We go backwards and we compute a capacity payment and an energy payment. We divide it by how much we're producing. We get this. We get this levelized cost of electricity here of $44 per megawatt hour, and we're going to put this into the financial model. Is this just a minute? Why am I using 47? Just a minute. I'm sorry. This was before we make a little half-year adjustment that Lazard seemed to make. So we use this one. Excuse me for that. And you can always find something by using this control, a square bracket next to the letter P if you've got an English keyboard, and F5, and these are in red, and I think I won't format the rest of these. All I'm going to say is something I said before, is be creative when you're making your financial model and set up a different scenario. You might have a page just for taxes. There might be some different tax policies you want to do some sensitivity on. And there certainly could be some different financial assumptions. And why would you ever put the two things in the same page? Now, most of the time when you get these interview tests and all that, it'll be much simpler. They'll just give you kind of one input. But in the real world, you want to be able to test all sorts of different financing, and in this case, financing and kind of tax assumptions. So that's just a little bit on the formatting. This, again, we might as well do this. We've got 5 at the top. And this time, I'm going to mark the links from another sheet. I'm going to use this one because it's a little clearer, okay? And this reversing thing makes it clear that you can see what's going on. And I think that's enough. And so it works through row by row, and it's going to show you what's a true false, what's blah, blah, blah. Okay, and I've done that way too much, but again, it's important, okay? And we put the units in there in a different color, okay? Now, let's work through and demonstrate that when we have this, how about let's do what Lazard does, and use a wind case at the start. And this wind case had a 20, let's just look at kind of our operating assumptions. We had a 20-year life. We had a 5-year life, but in this case, I put in a no tax rate. Just a minute. I put the tax rate just below without tax. So we have a 0% tax rate. And we have a gigantic 55% capacity factor, a pretty low investment cost. So this is a very attractive kind of thing. And then the fixed O&M seems to be somewhere about 20% of the cost. This is what LCOE, this is what Lazard measured as the LCOE. I should put that. Okay. And now let's just work through this financial model. It's ultimate, and then all I'm doing on this one is, if we take this simple case, it's the very first case. You notice I used a different color. No tax rate, 20-year depreciation life, which is kind of irrelevant. We'll use straight line depreciation. We'll have no debt financing, all equity, no at this case, we have no inflation rate. And so our weighted average cost of capital is our cost of equity, and we want to make sure that the model generates a cost of equity. Now, if we start our financial model, anytime you begin this, now this is, again, these are basic kind of ideas. But I could not possibly understand anybody who would not, I don't care what kind of project is in, you start with physically what this project is doing, whether you're selling hotel rooms, where you've got a real estate project with a number of units, whether you've got a hydrogen project that is using some electricity and then has some poor efficiency in producing hydrogen, and you have to get the megawatts and the megawatt hours, and I've repeated this way too many times now, but put this all in the same units. If you have to start switching from megawatts to kilowatts and all this, you're probably going to make some mistakes. Now, what that means is I had to, because I put everything in megawatt hours, I put the USD in megawatts, and of course, on the left-hand side, we show some of the drivers. And you might even, what I have been doing lately is kind of having one unit, the units are so important, one unit for the output and another for the driver. Because this is relatively simple, we don't really need anything. We have some degradation, and then we've got our generation, and for me, it's kind of boring these days to say, okay, we have to set up a flag. But even in this simple case, this one, the way this AND works here is that first H3 means not equal to 0. That's how you read this. If H3 is not equal to 0 and it's less than or equal to the 20-year life, then we're under the operation, and we could put this as operation period, so that's good. We're doing this a little bit, and then we have the construction period, which is just. I wonder what I did. I could have put not. No, I couldn't have put not this. It's just when this thing equals 0. Okay, fine. However you're going to do that, and then you multiply this by the capacity, and turn everything off, and you get the cost per in this case per megawatt. Multiply this. By the, here we multiplied it here to be a little more transparent. Put an inflation rate in. I strongly suggest you put that in as a rate and then do the index afterwards, and people will argue that that's what I did here is bad, and you could even go like this, Shift Control W, that's just got some things, and you put an equal sign, and you take this one multiplied by 1 plus the rate just up at the top, inside the brackets, not outside the brackets. Then you can put the operating life and just have this begin. We've got blue, so we have to do this coloring again. And I'm just trying to try to be fast and efficient. And look at this. Maybe I shouldn't have done that this time, okay? Great. Just a minute, I had to even reset this. Okay, I'm not going to bother resetting it. Then we put this levelized cost in. Now, this levelized cost, this comes from a calculation. And this calculation is made here, and we don't have to make this whole financial model. This is the kind of point. We could just simply put in our 12%. And at first, I'm just going to levelize out using the PMT function, levelizing out this 12%. And then we might have to make some tax adjustments, which we don't have to do in this case. And then we take our O&M and we convert the O&M is already in kilowatts per year. And if we have some, just a minute, if we have some, whoops, I went down too far. Excuse me. We have to make an adjustment for the degradation, and that was O&M. Excuse me once again. Okay, here we do. We use our 12%. we eventually could make an adjustment for the tax shield, but right now we won't. Okay, and just a minute, and then we put our final capital recovery of our capex in here. If the weighted average cost of capital or return on equity was zero, this would just be taking the total capital expenditures divided by the number of years, and then we add up and get our. In this case, it's ridiculously simple. We add up the O&M and the capex. We divide this by the capacity factor multiplied by the number of hours, and then we get how many hours we're operating per year in solar. That's the yield, and we could put that for anything, and then we can get USD per kilowatt hour or USD per megawatt hour or cents per kilowatt hour. And the final adjustment is we could take the weighted average cost of capital and if we were we divide this by 1 plus the cost of capital raised to 0.5 power to make it kind of a half year, assuming the money comes in a half year at the rest. Okay, that's how we compute it, and then we get our and again, I think the big deal is to put this file on the website. And then we put our revenues and all our operating costs, and don't be at all intimidated. I used to be intimidated. Oh, we can't do it. We can do this with solar, but not natural gas or whatever, nuclear, coal, or whatever. That's no problem. We get these other costs into USD or whatever we're getting, and we get our total operating cost. In this case, I have no inflation. And we compute the NPV we compute the IRR, and look, the IRR worked. And the rest of this stuff we're going to show you how to get depreciation, and then we're going to do some financing. And I guess we can go down here, get the cash flow, which is just your EBITDA, and minus the taxes, which were nothing, and we can then go down and get our taxes paid, which are nothing, and then get the equity cash flow. And in this case, the equity cash flow and the project cash flow are the same. And we should all recognize that if you take the net present value at the target IRR, that if the IRR is the same as the target IRR, that NPV is zero. That's kind of the old, horrible, disgusting definition of a IRR. We can put our profit and loss statement together. In this case, I did put some depreciation that we'll come back to, and when we put this depreciation in, here's the really nice thing, is that the return on equity and the return on capital are both 12%, and they're 12% in each and every year. And the only way that works is if you do not use straight line depreciation, and it's worth doing this in a minute. And we compute the economic depreciation as in 2 steps, we compute the net present value of the future cash flows. These are cash flow after tax, and it took me a full day to get this right. It's the cash flow after the taxes you would pay, and these taxes can be straight line. These taxes can be 5-year depreciation. They can be whatever you want, but it's the after tax value. And in this case, the IRR is our 12% target. And then you keep computing the NPV, and the NPV gradually goes down to zero. Maybe I should insert a little spark line here. and I'll just go, where's our value? So we take our value across here. This is, we could make it a little better, but that's not falling on a straight line basis. And any theoretical depreciation is the change in the value. So this is how much the value goes down. And eventually the value goes down, and the value goes down to zero, and you get the last depreciation in the very last year. Now I should be making so that's our depreciation. It starts low. It's nowhere close to straight line. And if you use that depreciation down here, it doesn't matter for the cash flow. And we're not going to use it for computing actual taxes. But if you use it in your final profit and loss statement, where the depreciation goes up, and then on your balance sheet, the plant value here, this plant value, we take the gross value and then take out the accumulated depreciation. So that's the same as our other value. And then if we do a balance sheet, well, the balance sheet will balance if we add the net income, and our dividends are just directly from our equity cash flow. That's our equity cash flow. We got a balance sheet, and make a little test for everything and make sure that equals zero. So in so many of these tests, they don't take you through the basics. I almost suggest, I'm not going to make up my own test. Next time I go through one of these tests, I'm going to kind of make sure we do a balance sheet, and I'm going to relax a little more. So there's our debt to capital ratio and everything else. Now, let's go to the next step. The next step we have after our simple case with no debt is we add O&M inflation, which seems to be really easy. In your project finance model, all that means is you're going to put an inflation rate here. It's irritating me that I have to do this reset. And remember, this time I don't have any things. Okay, that's what I should have done before. Now I put this inflation rate in, and this is what Lazard does, which I think you should start saying, oh, I don't know about this, because the revenues stay flat. The revenues stay flat. Notice that our equity IRR up here is 12%, and our LCOE is whatever it is. If we would have gone to if we would have done the prior one, it would have been 32, and because of the O&M inflation, it goes up a little bit. We put this in, now we have cash flow going down by a little bit, and I suppose we'll let's just put our little spark line in. I suppose you should do that kind of stuff. But be careful. If you're on one of these tests, please don't waste your time doing this too much. It goes down because of the revenues are flat and the O&M is going down. Notice that the IRR is still 12%, which was our target IRR. And notice that as we walk down, our NPV is still zero, and our balance sheet still balances. Now, the way that works is a little more painful, and I'm trying to this time go step by step, and I'm not going to get nervous like I sometimes do. And if this is taking too long, well, shut off the video. It is kind of, maybe for some people highly boring. But what we do is we compute the capacity payment. This is like an old-fashioned. It's not old-fashioned at all. It's a PPA agreement, purchase power agreement, where you have a capacity charge, a fixed O&M, and a variable O&M. But the O&M charge, it's as if you take that O&M charge that you're going to allow to inflate and levelize that at the same time. Now, in that case, I had to do a little work on this because we have an inflation rate, and then we compute the real the real whack, and then we realize if you take the present value at a lower rate, you get a higher number, okay? And just a minute. This is, ooh, and I'm totally afraid to do this now because I found a little mistake here. This should have been, I'm going to leave this for now because this is corrected here. We're taking the NPV at the real rate divided by the NPV of the nominal at the nominal rate, and I think I did degradation and inflation together because we'll get to degradation in just a second. And then we take our 20 US dollars and we multiply that by 50 plus 54. So it's this rate times this rate. Now I left that one kind of blank. I was going around and around. I've got to fix this later. Please don't yell at me for this. Oh, don't yell at me. Okay. Okay. But you see, I hope you see the idea. The key is this little PV formula, and let's try to explain the logic of this. The O&M expense is unlike the CapEx, that occurs year by year by year by year. So this -1 is just like a year by year by year over 20 years. This E10 is 20 years. And then we take the real rate in 49 divided by the nominal rate in 32, and a lower one, and that escalates, takes the present value of 1 over the entire period, and because you're using the real rate, you're escalating that at the difference between the real and the nominal gives you the escalation. We could have almost just perhaps done it with, let's just try this here. If I put PV of, and I just take the inflation rate, where's our 2.25%, and then take the 20 years and then put a -1 here. That gives you the whole NPV, and then if you divide that by the PV and you use a 0 rate, and then we put E10 and put a -1, that we'd have to go the other way. So let's try this. And I'm sorry, I'm experimenting here, but for me, it's kind. This is how I have to do it. I'm not quite as good as some of the other people. It didn't give us quite the right answer. So I've gone around and experimented, and we need to do this. Take the real rate and the nominal rate to make it work. That's good. I'm not a little that embarrassed by all of that. While we're doing this, please, if you want to, all these things here do is they just allow you to change the number. And I didn't put it here because it's kind of one off. Should I put it up here? Maybe I should put this up here. So let's get the financing scenario. So we're defining a financing scenario, and then you can use these buttons. Now, I have no idea why people, if you're running scenarios, why you would not use these. I really don't. And I use these in kind of big financial models, and I don't get in trouble from an auditor for doing that. Okay, because all they do is change that number, and you can change this number manually. I could change this to case number 1, and then it would grab all the, no, I couldn't. Excuse me. This comes from the scenario page. I've made that mistake on purpose, so I could change it here. I could change it here, or I could change it with a little spinner button. And of course, to get these little things, you go to the developer tab, you go to the insert and find the button, you put it in, and when you do this button, you of course have to, when you attach it, you're going to go from 1 to 20 or whatever you want to do. And the big trick is just to make absolutely sure you go to one page, back to the other page. And so you can switch this to a different page, okay? And you just then attach it, okay? Enough of that, okay? This I really didn't want to do, but if you want to make this thing and you've got these things across, well, all you need to do is you need to transpose, a little bit of a transpose. So in this case, I put transpose of the titles, and then this one says, okay, take that input range, which is down there. I put a couple of extra things in there, and then put the cell link to the, and we're at the input D2, and I don't know why it kind of didn't show exactly there, but okay. And one more thing, when you do this, you can attach these to a macro, and we're just going to do this one I didn't attach, very good, okay? But we can attach these to a goal seek macro in a minute. So that's our reconciling our PMT. Now let's get a little bit more complicated, and let's go to the next scenario, which is we put taxes in. And this taxes kind of drove me a little bit crazy, and thinking about the economics of a capital asset. You're really thinking about the economics of a capital asset. And the fact is the tax depreciation method could be this modified, accelerated cost recovery system. Aha, because I'm so old, I remember when it was ACRS in 1982, which was a radical change. And we had they're also different kind of rates, and these things don't even quite use the VDB, they're almost, and you can have a mid-quarter convention. Look, I went to the internet to get this crap, and Lazard, when they did it, they made their analysis very, very American, as if there's no other, place people are looking at solar or wind. And we would want to be able to use all sorts of different depreciation rates. Now, the way you can, I suppose let's do the easy thing first. The easiest thing is to say, okay, once we've got our operating cash flow, I should rename this free cash flow and finance, okay? And the free cash flow, we start with our free cash flow. We put this time, and we've got excuse me, this time I put in a depreciation rate. Notice the depreciation rate changes, and we should press Shift Control V for Victor. And if you notice, I go all the way to the end, so I shut up the auditors who complained, oh, you didn't go to the end on one of these sums here somewhere where it stopped anyway. Okay, it doesn't cost you anything in terms of slowing the model down, making the model bigger, blah, 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 blah. Okay, well, I suppose I could prove that. And then we better make sure that our total depreciation is the same as our total CapEx. That could theoretically be a little bit different, because sometimes if you get really fancy, you don't get depreciation on equity cost during construction, and when you compute these levelized costs, you really should account for that, but we're going to leave that. We're going to leave that out. Okay, so there's our depreciation, and now we have earnings before tax. Now, Lazard, in their little analysis, I put some of the footnote. It assumes a half-year convention in discounting. That's why we made that other adjustment. Full monetization of tax benefits or losses immediately. In other words, assuming there's some big mother company or some tax equity partnership or something you can do to get the benefit of this. That might be a problem, by the way. Okay, and then we have our tax rate. Now, this is where if you got kind of fancy, you could have put the unit for the output and then a different unit for the driver. And I do that these days. but I'm going to leave it for now. Okay, I think this is good enough. And so we get our taxes, and then we get our after-tax project cash flow. And notice that, again, I'm going to go up and change it to the prior one, 33. That was our if we have O&M inflation and no taxes, now we're going to add taxes, and we get a little bit of a higher cost because we pay taxes. Now that, you've got to be a little careful with that. That starts to change if you've got interest that's deductible, okay? But we get our after-tax cost of capital, and we go through this, and then when we work through the value, we take, before any financing, we just take the net present value of the cash flows after you pay these taxes just on the operations. The financing doesn't affect the depreciation. The depreciation is on basically the assets and how much cash flow you produce after tax. That's what you could really compute the project. You could call the project IRR, this after-tax IRR. Notice we did that project IRR after tax. We use the same thing, and then we compute the NPV, and we have our economic depreciation going all the way to the end. And I know a lot of you go, that's all right, economic depreciation isn't right. And then we don't have any financing yet. We have zero debt here somewhere. Here's our debt balance. We have zero debt, and we're going to get to that in a minute. We're going to go through the sculpting. Then we go through our cash. First, compute our taxes. We have these negative taxes up front. We have our CapEx, and we take away the taxes paid, and that gives us our remaining equity cash flow. And this is, I hope you're seeing, this is why I like to do this. We go through step by step by step, and then we compute our economic depreciation, our EBIT. But these taxes, just a minute. Oh no, these are, I've got an error here. These are the taxes paid, okay? Because this is not on this taxable income. This is on including the negative. See, this is very good that I'm going through this. And then we have our accumulated depreciation, and this really is our balance sheet. And I should have put it up here, and I should have made an extra ABCD to put it there. Maybe I'll just put a balance sheet here. And shit, I didn't put shit. Balance sheet. Okay, and then we'll get our assets, and then equity as normal. We put in the amount of equity we paid, which is just the CapEx. We get our net income back, and for the net income, we use the actual taxes we pay. I didn't put any. You could make some calculation of deferred taxes, and I started to do that. I said, screw that. And then we put in our dividends, because our economic depreciation is actually handling the deferred taxes correctly. And then the dividends is just the last line of our cash flow statement up here, which we use to, and maybe I should have, I think this is so important. I'm going to put Shift Control G. I know people don't seem to like the double underline, which sorry, I like that. And then we have no debt, so that's our equity, and everything balances. And the good news, this is the big deal, is when we compute our return on equity, because of the way we did that economic depreciation, and it took me an experiment. I've wasted a whole stupid day on this when I should have been doing other things. Oh, but that's okay, as long as it worked. And our return on equity and our return on capital are the same thing. We have no DSCR. And that's our case with taxes. I'm sorry I'm going through each one of these, but not that sorry, because you can turn off the video, obviously. So now let's go to the next step, and we'll leave our wind case on, In this case, we're going to put, I'm going to take away the taxes and just put some debt on the balance sheet. And this is where it starts to get tricky too. So let's again go, just a minute. No, I got to go back to the taxes. To make the taxes work, here's what you have to do. If you just want to use a formula and you don't want to waste time on making a financial model, and when I get finished, I'm going to explain that really you could do all of this without a financial model. So we started with our regular old, I'm going to put the degradation in last because stupid degradation drives me crazy. And you can see how I made that little mistake, and I'm a little nervous. I've got to fix that before I upload the model. We have our regular capital charge rate, which we used with our 12%. But then we go to the financing, and at the bottom, this is kind of like this input S versus input C. Other people who were purists would have put this depreciation rate into a separate input file because maybe you wanted to compute 10 different depreciation rates, and I have nothing against that. And right now what we're doing is we're applying I put a little true and false. If it's true, just a minute, then we use the red one at the bottom. If it's false, we use the top one. So this is false. This thing comes from, if the life is different, here's what I did. I said if the lifetime is different than our MACRS rate, this is not very good. Oh, this is embarrassing. Whatever. Then we're going to put a false, and if I would have, just a minute, if I would have gone up here and said, which we're on this one, so we can see which one, if taxes and no debt, just a minute. Why do I have that backwards? Okay, I did this a little bit badly, but I said, okay, in this case, we're going to use a 5-year life, and if we use a 5-year life, we're using that MACRS rate. If I would have, let's just look at this. So pay attention to this. Right now, we haven't been talking about the real LCOE. We've only been talking about the nominal LCOE. If we talk about this, and if we put a 20-year life here, well, look, 5, 35, 20, it changes it by quite a bit, okay? And so I just made a little horrible thing here. If it's 5 years, we're just going to take that MACRS rate. Otherwise, we're going to take a straight line. So if I put here 20, it gives me the 5% rate. So that's how we do that. And then once you do that, here is the big trick. And again, I made mistakes, and I need to emphasize this, and I need to document this on my website because I can never remember it myself. We take the NPV, and when you take the NPV, you don't adjust it for the real rate or anything else because taxes are always based on nominal, at least just about every country. There could be a tax where you adjust it for inflation. But if you don't adjust the depreciation for inflation, you always use the nominal rate. Okay. And then when we use the nominal rate, what we do is we realize that present value of that tax shield is a benefit, and it's kind of like a reduction in CapEx, but then we got to pay taxes on the equity. So the first thing is you put the tax rate in and multiply what the tax shield is. It's the present value of that rate. Now again, if I put in on this one, I guess, if I put in 20 years here, okay, And then now you can see that that PV of the tax shield went way, way down. Okay, it's like an increase in CapEx when we have less of a tax shield. That's how you can do it, and that's the theory behind all of this. And then you can take this, and I'm going to do this. I'm fixing some of this stuff here. You just multiply this one, this number, by the tax basis, which was up in line 14. Okay, perhaps I should have even shown the investment cost up here. I'm not going to do that right now. I think that's okay. And then again, this is bad. We could it gives the same answer. Then we take we levelize this payment out, just like we levelized out the capacity payment, and you get this as the value of the tax shield. Okay. Oh, I'm sorry. This is the net kind of CapEx you spend. But then we're not finished, because we have to take this. See, this is good. I'm going through this, I guess. We have to take this number and gross, you could call it grossing it up for taxes. Anytime you've got equity cash flow, if you're going to see how much equity cash flow you need, then you're going to have to pay the taxes on the equity. But that taxes you pay on the equity gets taxed, and that's why you divide it by 1 minus the tax rate instead of multiplying it out. Okay? And this, we don't have to worry about the rest of it. Okay? And when we do that, then we go all the way down and get the capital charge rate. And notice how you've got to be I think you should be so careful with the units, because this is per year. You take hours per year. You take that divided by that, and it gives you kilowatt hours per kWh instead of kWy. Multiply it by 1,000, and you'd go step by step by step and go really slowly. And this number, when you put this number in, this number, Alt-MD if you want. Yeah, okay, whoops. Well, this number better have come from there. Okay. Oh, it came from way down there. Okay. F5. Let's go back. Okay. So that's the flat, again, levelized cost. And then the payment, again, now our PMT formula still works, and it conforms exactly to a financial model. Okay, I'll go back to the degradation in a minute. The degradation is kind of the reverse of inflation, but the degradation affects you have, if you're going to have less sales, less generation, you're going to have to gross up the capacity payment and the O&M payment, and you have to do it differently, and it's a little bit painful, but it all can be done mathematically. Okay, now let's go to the next step and go to our let's put debt into our financial model. Okay, so I took the taxes away and put debt, because debt scared me a lot. Now in this case, again, what happens is that I'm just going to tell you, this number comes from here, and we can compute this number with the PMT just like before. And if I skip all the way down, now we go down to the balance sheet. Okay, that's let's do this income statement. Okay. We go down to our balance. We have some interest that we're paying. Okay, and we get our income after interest, and this time we have debt and equity on the balance sheet. The balance sheet still balances, and even cooler, which I never was able to kind of do before, we get the same return on equity each and every single year. How do you do that? Well, here's how you do that. You go up and you compute the economic depreciation in the same way. This time we have no taxes, so this economic depreciation is this. Basically, it's the same as the EBITDA, and you take the NPV of the EBITDA, and notice the rate we use to do this is 8.8%, and I think we put in 12% as the cost of equity and 8% this Lazard cost of debt, which is a ridiculous number, by the way. And then we put the financing in. And here's the big trick. You have just up here the economic value of your asset, and you have the debt at 80% of that, and you take that same debt each and every year, you take it straight from the balance sheet, and the economic repayment that makes your balance sheet stay constant over time is it all works because of the economic depreciation. Okay, don't look at these other methods right now. So then we compute basically a debt balance like you always do, but this debt balance, this repayment, I put a little flag because we're going to use alternative repayment, comes from the economic repayment up here. And you should be able to press F2 all the time and see how these things work, and there should not be any complicated formulas. Any Excel showing off is just, it's so irritating, I can hardly stand it. Now we have a project IRR of 8%, and I think we work through the balance sheet and the income statement. Everything works, and down here, the only thing you need to do this time is compute the weighted average cost of capital. Ooh, that's a word I hate in project finance. I rail about this because the risk of a project changes. The risk of a project changes over time so dramatically. But, excuse me for not getting a word out. Now, when we go through this time, if Alt-M-A-A, I think is the way to get rid of those things. Okay, we have our present value of our tax shield, and we basically just do everything, all our PMT calculations, and eventually when we do this, we're going to, where's the PMT, we're going to use the weighted average cost of capital, and that weighted average cost of capital is after tax. So let's move to the next scenario. And I hope you see, if you're still watching this, you deserve some kind of prize. But I don't have, you can get half the revenues I'm earning on this video. I'll give you half the revenues. Let's see, that's half of 0. Okay, well, sorry, I should give you a better prize than that. Okay, and now let's put, I haven't figured out how to get advertisements and beg for some money or any of that crap. Taxes, and now we're putting taxes back into the equation, and this time we'll go to the project finance model again, okay, and when we go to the project finance model, we start with our operating cash. This time we have our tax depreciation. We have our taxes on EBIT. This is kind of the operating taxes. You compute your project IRR, but notice that the project IRR changed. The weighted average cost of capital changed. If you want to see this, you find a green one and you see, okay, this changed in this case. Oh, this came from somewhere else. Whoops, this came from this one, okay, here. And this time we adjust the debt times the 1 minus the tax rate. Whoops, I didn't want to do that. Okay, and then we get our economic depreciation here, and we put our economic repayment in. and we're everything's let's do this, and I just find this just absolutely beautiful. This is artistic. This is like, oh, I just get so excited by this. Our return on equity is still 12%. Our return on capital now is that's a pre-tax return on capital, and when we did this whole NPV business here, I think it was down here, we still get an equity IRR on the equity we take out of our pocket, which is the CapEx, add back the debt. That's the equity we take out. And then we have to pay the interest and the principal, and his taxes is the taxes actually paid, which is the tax after the interest. And how magical that this all works. Okay? And this is it's almost where you could stop. Now, here's what happens. We could also, let's see what the next one I did. Then we could do the sculpted debt. Now, when you do the sculpted debt, how about this? I'm going to skip over that one. I'm going to skip over that one, and I'm going to go to this level debt, okay? And when I go to the level debt, this is, if you look at how Lazard did their analysis, okay, I wonder if anybody would ever look at this. And I spent all this wasted time on this. But you look, they have a level debt service. So they just have a flat debt service. Now, the problem with this is the taxes and the inflation and all that are going in all these different directions. That's not going to give you a flat DSCR. So when you put in this scenario, now suddenly in this scenario, it's not working. It's not working. And just a minute. It's here. I compute the level debt service. I say, okay, well, here's our debt. The level debt service. We use our classic PMT function. Now, I like the fact that they did it over the life, because that basically assumes you're going to refinance and refinance and refinance, and it's a whole lot better assumption than just saying, we're not going to put in debt for the life of our project. So that's good. Now, and you notice I put a little test in here, and I think you can put the key test just like this if you press Control. That comes from here, and the test says, here's the IRR you get for the equity. That's a false because it's all a mess. Here is the NPV, and what we want to do is generate that 12% return, just like kind of Lazard does it. So this time, unfortunately, and I'll try to explain why in just a minute. This time, if we need to do a goal seek and we need to set, I gotta go and get a battery. Just a second. Okay, so when we do this, what we really want to do is say, okay, I don't know what the project IRR is. Now notice I put a little thing here. If you press Shift and right arrow and Shift Control F3, it just gives you the range name, okay? And then if I go to this page, up here, instead of putting the the project IRR in here, and I might have made a little bit of a mess on here. I said, well, I'm going to call what Lazard does kind of project finance, where we don't use the balance sheet. We just put a flat rate in here, and then this one, you notice it's project IRR. So I'm going to make a goal seek, and I'm going to just, and really it's hard to imagine for me any model that has something to do with structuring. In other words, coming up with a contract structure, a price structure, a debt structure, an O&M structure, all of these things that does not have some kind of goal seek at the end. So I'm not going to press this. I'm just going to do this one by hand. So we always, and again, when you do this goal seek, you set the difference to 0 by changing the some other variable. Okay, and this time it's the project IRR, which would be often what I would do, and it does the goal seek for you. Okay, and what that means is this project IRR this time, this project IRR was not the same as the WACC. We were able to have a lower project IRR, and when we have our lower project IRR, let's just show you what happens. So this time, I put the repayments in a different thing. The repayments are the total debt service minus the interest, and I would always use the opening balance for the interest so we don't have a circular reference, and this is a little true and false for saying, which repayment are we going to apply? Ooh, almost too complicated, isn't that? Not really, it's not that complicated. Okay, and we should kind of make a little test to make sure that the debt balance goes down to 0. And when we do all of that, we go downstairs, and this time you cannot, at least I don't know of a way to use the PMT function. And that's where it kind of stops. So if we, this time the equity capital goes crazy because we have those different cash flows occurring, and the debt capital also goes crazy, and you could make an argument, well, that I don't care, that's the way it really works. But then you've got and this time the return on equity, and we can't get that wonderful magic with our economic depreciation, and our DSCRs kind of, well, they're not that bad. The DSCR is the EBITDA minus the taxes, and the debt service is the interest and the repayment. When we get those negative taxes, we get a high DSCR, and then lower one. Let me just make sure that in this one, let's change this one and change this one to 5 years. Okay, let's make sure this went to 5. And then when we go down here, now we've got this 5-year depreciation. We go up to the financial model, and we have our depreciation changing. This time the LCOE went kind of, just a minute. Let's just make sure that I did that change. Is the NPV still equal to 0? That would shock me if it was. Just a minute. Yes, it is. I'm going to put the goals. Okay. Okay. I'm not sure. Oh, because I think I automatically ran the goal seek here. If we look at this, I think this was different. Okay. And so then, but here's what I wanted to show you really with this scenario is, perhaps it was already there. No, this looks the same. Okay. Do I have the 5-year depreciation? I'm just making sure. Yes, I do. Perhaps I had it in an earlier case and I didn't realize it. I think that's what happened. Excuse me for doing that. This I can still put 20, and this is I made kind of a mess of that. This tax life is the one that's different. So if we put the tax life here to be 20, excuse me, then this IRR test doesn't work. And this is a goal seek. I'll take you through that in the next video. But here with 20, we have the the LCOE to be 32, and with 5, I have it to be 25. It made a really dramatic difference. And if we put 20 in here, let's just look. And so I'm running this goal seek here, and maybe people don't like this because it would be nice to have an automated goal seek, which I've shown before, and it's a pain. Frankly, it's a pain because you've got to go through all the mathematics in the model. So now I'm just going to look at our, here we have our DSCRs. These DSCRs are more flat because of it. Now before we get off a little bit and before we finish this, there's one other method we could use. We could use essentially a sculpting method, but in this sculpting method, we're going to start with 80% debt, and then we need to compute the present value of the CFADS. Now, the CFADS officially should be after all taxes, not just operating taxes. So I call this an approximate tax, and I was a little bit crude. I started one period out to get the NPV, and then we get a kind of flat DSCR. So let's implement that method, and I call that the sculpted debt method. Okay, and this method, just a minute, in this method we said, okay, apply straight line, apply project financing, and apply the sculpting. So when we do this one, I'm wondering, again, when I changed the method, it automatically ran a goal seek and gave me a different LCOE. So whenever we do these kind of different, we could call them project finance techniques, we have to run a goal seek, kind of like Lazard does. And in this case, when you do the sculpting, it gives you something kind of close. And perhaps if I did this after tax, now if I did this after tax, I'd have a circular reference, and we'd be almost back to our balance sheet approach, which is really interesting to me, which I wouldn't have known. And I just want to stop here for a minute and tell you, if you're making a model, if you can think about things instead of just starting the Excel and then let the Excel guide you along and see if your theories are correct or not, I think that's really exciting, okay? And the ROE is almost just right and not quite exactly right. So let's just compare kind of three different methods. We can look at our LCOE. We're still on the nominal LCOE. Okay, and then we can say, okay, well, let's do this balance sheet debt. That was 33. The sculpted debt is 30, almost exactly the same. And this one with the level gives you a little bit lower of an answer. So the issue really is, you need to go through all of these. If you're going to run the goal seek and do the levelized debt, you need a project finance model. If you're not, and perhaps you want to put a P90 and perhaps you want to make it a little fancy, and then you need a kind of a little financial model because it's going to give you a different debt size. But if you are just saying, okay, I want to whack and I want to compare different technologies and I want to do them on a kind of fair approach, using an after-tax cost of capital and working through this PMT approach will be basically okay. Now, if we go through the kind of the last thing I want to do is talk about this real IRR, and the way the real IRR works. Perhaps I'm going to go all the way down to this thing that says real LCOE. Now, when you do the real LCOE, all you do is you take just a minute. So let's just make sure I'm using a 20-year life. I'm using all the same kind of things. And then what we do is we work through exactly the same thing here, but we use a real IRR, which is 1 plus the nominal IRR divided by 1 plus the inflation rate minus 1. That gives you the real rate you're targeting. And you take that real rate and you take the PMT formula with that real rate. After you take that a real rate, then you take the nominal value of the tax depreciation shield. Okay, and just a minute. This is the capital value without the charge, and just a minute. Am I on the? Okay, I've got to pause for a second. Now again, I should be emphasizing it's hard to do this a little bit because you've got the theory, which is most important, and the theory says we're trying to find a level rate in real terms, not in nominal terms. So we're going to allow this level rate to go up with inflation, like everything, like theoretically we did with the O&M expenses, and by the way, the natural gas prices and everything else. We matched it to Lazard and demonstrate that Lazard escalates the natural gas price. So why don't we do the same thing with all parts, with everything? So this one is this. And, you know, sometimes I'm not sure if I should do this. I'm not sure if this is worthwhile doing sometimes. And you can use this formula text. If you put a little, if you copy and paste it, it's wonderful. Then you can do a lot with the formulas. But that's what this does. I don't think this really worked that well because maybe we could have put range names in, which would have got messy. Okay, and then we get to the O&M. And the O&M, we could adjust for degradation, which is like the opposite of inflation, but we've already got this in real terms. So we get down to the total O&M. Just a minute. Okay, now I corrected this factor. Excuse me for that last little glitch, but I'm going to leave it. Okay, we should have, this should have been adjusted only for the degradation. And then we get the total O&M, and we get our target IRR, and we get this number. And when we put this number in a project finance model, now we go all the way to the top. And when we go all the way to the top, excuse me, blah, 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 there's no degradation, excuse me, and then we go to the operating cash, and our revenues are allowed to escalate. That's the big deal. We compute the LCOE, this starting value, and then it escalates, and we put all of we've got all of our depreciation. And this time, I hope I put the sculpting in. I think I did. I put the sculpting in. Excuse me for hesitating here. And we compute this target DSCR. And with this sculpting, remember, we didn't get exactly the same rate. It wasn't precisely the same. But this time, the repayment, the repayment, just a minute, where can I find the repayment? It starts low and goes high because we're earning more money as the revenues go up, and that's how sculpting works. And we finally go down to the end, and our equity to capital is a tiny, tiny little bit different, and our debt to capital is a little bit different. Now I'm going to just put in our economic debt value, and I'm going to pause for a second. Now, when we do this, we get, when I put in excuse me, the economic whatever debt. Remember, that's where we compute the value of the asset changing with economic depreciation. If I was trying to follow this, this would be a little bit, this would certainly be difficult, and I'm not suggesting that you apply some of this stuff in the real world, but it really does demonstrate kind of the accounting and the thinking about assets, the importance of economic depreciation. Now, if I use this time, I'm using the applied rate is the rate we computed from our PMT calculations and everything else. And we go with this real rate that escalates, and we go all the way down here, our 6% target. This has got a lower ROE, this scenario. This 6% is equal, and everything's balancing. Oh my gosh. And the DSCR is just about constant too. So that economic method is kind of really good. And let's finish this. I have not talked about degradation, and I have a couple of glitches to fix in that model. I've convinced myself I'm going to go to a nuclear best kind of case, run all the scenarios. This time when we get to the very end, okay, and what's going on here? Why is, okay. Let's put it on. Okay, sorry, I got to make that the flexible scale. I guess I fixed the scale at the wrong level. But and this time, just a minute. Okay, so this time I put what I call the economic value of the debt in each scenario. And we still get this, it's exactly the same result, this dramatic effect of incorporating the real rate, incorporating a longer life with the real rate, with a lower cost of capital. And you get this completely dramatic kind of result. So that's a very long video. Got some theory and some modeling, and if anybody has made it through this time, so you've got to send me an email and tell me you really were able to survive this. That would be fantastic.